Okay, so this is the intrinsic valuation of financial institutions. What we're going to do is we're going to go through, and first what I'm going to do is just, what is the goal objective of this exercise? This stock analysis and valuation outline aims to equip and guide students to apply security valuation techniques employed by financial analysts. This guide explores techniques, models, industry practices used in the valuation and selection of securities that includes both quantitative and fundamental analysis. So the overview is, we're going to go through a company overview. You're going to go through a company overview. On one of your slides, you're going to articulate the company's strategy to drive revenue. You're going to show the organizational structure. You're going to talk about the culture, the peers, the industry, its products and services, financial condition and ratio analysis, and I'll show you how to do that later. The financial analysis and the projections, and the stock valuation methodologies. Okay, and then you're going to make the recommendations at the end. Buy, hold, sell. I want to see the buy, hold, sell on the front of the presentation from the examples that you've seen, and then the trade recommendations. So if you know it's going to be, if it's a buy recommendation, then you know you should be buying calls and writing puts and buying on margin. All right, so let's go through the details here. So the company strategy, you're going to do a SWOT analysis, strengths, weaknesses, opportunities, and threats. The organizational structure, and again, this organizational structure, these financial institutions, just to give you a little tip, is that they've restructured pre-post Dodd-Frank, okay? Prior to the financial crisis, they had a lot of trading activities, proprietary trading activities, a lot of commodities trading, alternative asset trading and advisory was in the organizational structure and was reflected in the income statement and the balance sheet. That has been restructured. They do more commercial lending now and investment management, and they've spun off their proprietary trading units as individual hedge funds. A lot of those guys just spun off because they're not core to the bank holding company charters. So they had to spin off. So the organizational structures that you're looking at now for these firms are significantly different than the organizational structures pre-Dodd-Frank or pre-financial crisis. Okay, so just remember that when you're reading the industry reports. And I put the industry reports up there to read, so you need to read through not only the company reports, but the industry reports, because you're putting the company within the context of the industry, and you got to know what the opportunities and strengths are. And those companies are being, affected right now, so this is a really good time to be doing the analysis. Okay, you're going to learn a lot from it because the environment has changed, and the environment is changing, particularly after 2.2 GDP growth in the fourth quarter, and we only had 125,000 jobs that were created last month. That's like half that we've been generating per month over the last 2 years. So if we're heading into an economic slowdown, then the Federal Reserve probably is going to keep interest rates lower, and that could continue to put pressure on margins for the financial institutions. So you got to put it in the economic context too. You want to look at the similarities and differences between the top 5 firms, and those are going to be your peers. Okay, Citigroup, Wells, B of A. You got Goldman, you got JP. Those guys control 50% of all the assets in the banking industry. 50% of all the assets. 50% of the market share. It's basically an oligopoly, but that's your peer. Okay. So you got to be looking at those guys too and knowing what they're doing, because if they're competing against 5 huge other highly aggressive individual banks, it's not going to be top-end revenue growth that's going to be generating the valuations. It's going to be, how do you steal market share? So that's what you're going to have to talk about too, is what are their strategies to steal market share. And then who are the competitors? We already talked about that. And when you're looking at the competitors, look at the comparative advantages that they have over their competition. Wells Fargo is very strong in mortgage financing. Goldman's not. Goldman's very strong in M&A. JP Morgan's pretty good too. But Goldman's the brand. Goldman's moved into real estate lending. JP Morgan's really big into asset management and wealth management. So that's why I was saying earlier, you got to look at the divisional lines and look at where the revenue streams are coming from the institution, for the financial institution. And you're going to see that the asset mix, the product mixes are going to be slightly different for some of them. That's going to tell you where their comparative advantages are. The organizational structures are going to be slightly different. That's going to tell you where their comparative advantages are. So you really need to kind of get into some of that MBA type strategic planning, and analysis work. Products and services, we talked about that. Again, think about, of the total revenues, where are the revenues coming from? Not only from a contribution standpoint, but what products and services are going to be driving revenue in the future. And theoretically, we're not going to do it here, but each one of those divisional lines, each one of those product lines has its own multiple and its own growth rate. But we're not going to be getting into that much detail. But if you do start reading into the firms, you should be thinking about asset and product mix, composition, and revenue growth contributions by those products and service lines. Financial conditions and ratio analysis. You're going to be comparing Goldman to JP, to the peer group, to the industry, and then you're going to be giving me basically an overall financial condition. So if the leverage ratios, what you'll see is Goldman is highly levered compared to the others because they're really into driving return on equity. So they're willing to lever up and take on more leverage risk or more credit risk to drive that ROE. So when you look at the financial ratios, you want to compare the target firm, the subject firm, to the comparable, which is the peer, which is JP Morgan, the peer group, the industry, and you're going to tell me based on the asset ratios, the income ratios, the return ratios, the leverage ratios, if it's excellent, good, average, below average, and poor. And they're probably not going to be poor or below average. They're probably going to be average to good and excellent. They're probably going to be good to excellent. And in most cases, the overall financial condition of the firm is going to probably be good. Okay, I'm guiding you a little bit here. But that standard ratio analysis model you'll be able to use across different industries and across different firms. So different types of ratios: debt to equity, debt to total market cap, interest coverage, cash flow to debt ratio, return on equity, return on assets is extremely important in banking. Net profit margin, interest margin, right? Economic value add is extremely important. Spread between your return on assets and your weighted average cost of capital. Earnings per share, PE ratios are going to tell you growth rate prospects for the firm. Dividend payout ratios, dividend payout, dividend yield, EBITDA multiple, and enterprise value. Total invested capital, return on invested capital, the DuPont method obviously is extremely important. Financial analysis, you want to look at trends in revenues, trends in earnings, EBIT, and operating income. So you're looking at if you can get historical information, you can see how the earnings and the revenues move across the cycle, the business cycle, benchmarked against the business cycle. So if you know, like when we were first doing this analysis a few years ago, we were coming out of the financial crisis, we were coming out of the recession, so a lot of the earnings per share for a lot of these firms was still negative. Well, I can't use a negative EPS in the valuation process. I had to grow it out 2-3 years to get to a normal EPS. Or I had to use EBIT or EBITDA. I couldn't use earnings per share because they were negative. So I used EBIT and EBITDA per share to be able to get some kind of relative valuation to get kind of an idea of what the firm's value was. The other was to look at technical analysis. You want to be looking at the chart, of the stock price, because there's going to be resistance lines and support lines historically that are going to show where the stock price could potentially go, but I don't think the stock prices for a lot of these banks will ever reach the heights that they did in 2006 and 2007 because we were under basically a deregulated environment. Interest rates were still low, asset prices were inflated, and they were generating a lot of revenue using basically non-core bank revenue streams such as trading. And derivative trading, which is not going to be part of their revenue model. So I don't see, B of A and a lot of these other banks getting back to their 06, 07 price peaks. So maybe there's an interim price peak, before that. If I had historical pricing data, I'd be going back to the late 90s and maybe the late 80s to get kind of an idea of what the stock price could potentially be. But if I know that I got some price resistance, I got stock price that's way out of whack in 06, 07, but I can see that there was some historical resistance in the pricing, and I know what the supports are. Well, if the stock price basically bottomed 2 years ago, and it's been in an upward trajectory, I might just do a linear projection, on the stock price out another 12, 24 months if it looks like there's momentum. And if it looks like there's underlying fundamental demand for their products and services along with continued recovery in the economy. So again, you got to look at the pricing history, you got to look at the revenue history, and do some technical analysis along with the fundamental analysis to be able to get some kind of trending, not only in the revenues, but also the pricing. All right? Okay. And then the stock valuation methodologies. And I'll get into a little bit more detail on this. But again, it's not rocket science, right? If we know what earnings per share is, or EBIT, or EBITDA per share is right now, and I grow it out, 1 year, or I want to grow it out 2 years, and I know what the discount rate or the WACC is. Well, I got the earnings per share, or the EBIT or EBITDA per share divided by the discount rate or the WACC, and that's going to give me a value. Okay, Gordon growth, again, you got to be really careful, when you're using the Gordon growth model, because that G component is going to be significant. So you're not going to be using 5 or 4, you're probably going to be using 3, 2, and 1. If G is 0, you're using perpetuity. So there's basically your scenarios right there. The PE multiple approach, again, I would be looking for, in the numerators, we use D theoretically, but this could be EBIT or EBITDA or earnings per share 1 year out, okay? 1 year out. Because the stock prices are forward-looking. Investors are always trying to figure out what the stock price is going to be in the future. So you want to use, your numerator needs to be 1 year out. Projection made by you, based on your analysis. Not somebody else's, but what you think. All right, so the PE multiple approach. Again, the PE theoretically is really 1 divided by the discount rate, or it's the forward-looking stock price divided by the earnings per share forward-looking. Could be the current stock price by the current earnings per share. It could be, some combination. So you can play with it. You could use the current price, current earnings per share. You could use a forward-looking price with a forward-looking earnings per share, which is probably going to be more accurate. Again, because you're the analyst, you're doing the fundamental and the forecasting. Okay? And then the discounted cash flow approach, the DCF. The DCF, again, you are going to have to come up with the growth rate assumptions per year, and I would use a 3-year holding period. You can use 5 if you want to, but I would use 3 because it's easier. Okay? So you need to, what I would do is I would come up with an earnings per share or an EBIT or EBITDA per share next period in the future, or come up with the current period earnings per share or EBIT and then grow it out and use that as the first year earnings per share. So I would have an earnings per share today, I would grow it out, and I would use that as the first year cash flow. Okay? Not today's, but a forward-looking cash flow. So if you know what it is today, you grow it out 1 year, maybe you think it's going to grow 3%, 1.03, grow it out, boom, there's your first year, all right? Then you're going to need to grow it out again for the second year, grow it out again for the third year. You got to come up with the growth rates. Then what you're going to need to do is to grow it out 1 more year to the fourth year, and you're going to apply a multiple on it, or you're going to divide it by some perpetuity discount rate, or if you're going to be really aggressive, you're going to use the Gordon growth model to get the terminal value. Take the terminal value, put it into the third year, add that with the cash flow, discount it all back, boom, you got the present value per share for the stock using the DCF. Okay, so again, it's not rocket science, but if you set up the formulas right in Excel and the valuations grids, which I'll show you in the presentation, you should be able to work through this stuff pretty quickly, so that what you're focusing on is really the value add of the analysis, not the going through the mechanics. And I think you've gone through enough of the mechanics to be able to do this exercise pretty quickly. Okay, so that's lit. Why don't we stop the camera and then go through some examples, and we'll turn it back on again.